This month, Life Insurance Strategies Group is in Bermuda, but we've been thinking about the economy back in the U.S. At a recent conference, I was asked my opinion of what I thought about any potential tax changes that might come up in this Congress. And I said, really, for the focus of my clients, we really look at life insurance and determine how that fits into a portfolio. And that really kind of cuts down on the noise about what you think about maybe the rest of your portfolio and the taxes there. And let me explain. So people think about life insurance for protection or accumulation. So protection to provide a death benefit, to pay liabilities at death, or accumulation to pull out income later on. But really, overall, and a much broader look at life insurance is its position as a contingent asset class. So let's think about your portfolio. In any portfolio, at sort of one end, you have less volatile but low returning assets like bonds, treasuries. And on the other end, you have some volatile assets that have the potential to return greater returns or maybe not at all. And those are alternative assets. But when we look at life insurance and see how it fits into a portfolio, it's really sort of amazing. So let's think about how people judge investments. So going back to the 1950s, there's the modern portfolio theory, where they applied a Sharpe ratio to different asset classes to determine, how volatile are these assets? What kind of stability can we have in the return? And when we take that math and those formulas and we apply it to cash value life insurance, so things like whole life, universal life, index universal life, variable universal life, and even private placement life insurance, we have an asset that has a pretty decent return that is tax-free and has a high probability of being fairly stable. So you're not going to see a lot of volatility in life insurance policies compared to other asset classes. In fact, the Sharpe ratio is many, many times more than other asset classes who are tightly grouped together. So think about this in your portfolio. Life insurance now, let's think if we go have stable returns in there of 7, 8, 9, 10%, and they're tax-free, and we know that the stability of that return is going to be fairly, stable, doesn't that make it pretty easy to position in a portfolio? And so let's think about that. So in a portfolio, on one end, those taxes and bonds, and life insurance can kind of sit near that as a safer, more secure investment. But within life insurance, you can take advantage of its tax-free environment and invest in things that you might not otherwise think of doing in that part of your portfolio, meaning sort of the safer, less volatile part. And that would be investing in perhaps alternative assets, so hedge funds, things that you might do in private placement life insurance, or even in retail variable universal life, maybe some more aggressive investment options. So it's a pretty fantastic use of life insurance. And I tell people, with the rest of the economy, we're seeing a lot of ups and downs and volatility. But if you have life insurance, which is professionally managed, either by a life insurance company or in the case of private placement life insurance, your manager, you're probably not seeing that type of up and down. You're probably seeing a lot less volatility. Now remember, at Life Insurance Strategies Group, we don't sell products. We help our individual clients and our corporate clients make decisions about complex life insurance transactions. If we can help you, reach out to us at lifeinsurancestrategiesgroup.com.